All right, hello and welcome to the speed banking class. I am so excited to share this strategy with you because I think it's one of the most powerful strategies that I have in my tool belt, not only to keep wealth and pay off your debt in a fraction of the time, but also to build wealth, to go out and be able to buy assets. So, as usual, like with every module, before we dive in, I do need to share a disclosure with you. I am not a licensed attorney, accountant, financial advisor, broker, agent, or any other licensed individual. Even if I had a license, I'm not acting in that capacity. Therefore, I'm not going to discuss or provide any specific counsel, advice, or instruction that would apply to specific individuals. This workshop is intended to be general information. I recommend that you engage the services of professionals in making decisions that have a legal impact, especially financial decisions. Now, with that out of the way, let's jump in and let's start talking about some of the benefits of speed banking. So, some of the biggest benefits that I find of speed banking is that you can pay off your debt at an accelerated rate, and the very system that we use to do that also makes us pass a whole lot of interest and not have to pay it. We pay less in actual interest, even though the tools we use might have a little bit higher interest rate, and you'll see what I'm talking about as we get into it. The principles that we use allow us to bypass a ton of interest, and we end up saving money in the long run. We also pay more principal towards the debt, so we're paying down the debt faster, and that's how we increase the time in which we pay it down. By doing this, we also increase monthly cash flow. We're going to talk about something called cash segmentation, and that is the very thing that keeps most people on a paycheck to paycheck basis. And that's because they spread out their money. They get their check, they put it in their checking account, and then they pay a whole bunch of bills to all sorts of different places. If we can reduce the number of people that we're paying, the number of payments that we're paying, that makes our monthly cash flow go up. So I'm excited to show you how that works. You're also going to gain access to more cash, acquire more real estate, and achieve more of financial independence, potentially by doing this amazing strategy. So what is speed banking? Well, speed banking is a strategy used by the wealthy whereby common banking tools are leveraged to increase your monthly cash flow, pay down principal on amortized loans, and accelerate the overall debt payoff and minimize the amount of overall interest paid. Speed banking uses math to exploit advantages for the consumer over the bank in the use of certain banking debt tools over other more common banking tools. So basically what that means is that we, as people who went to elementary school, middle school, and high school and public education, we were not taught a whole lot about finances. We were taught very, very little. And so what we end up doing is just doing what our parents did, doing what grandma said to do, doing what Uncle Bob said to do. And those things can potentially lead us to spending more money in interest, to spreading out the timeline in which we pay off our debt, because they don't know either. I mean, to be honest, most of us follow advice of people, financial advice of people who we would never want to actually be like financially. So we use actual math to go in and look at, okay, if I use this tool with my current income and my current situation versus this tool, which one will pay off the debt faster and cheaper? So we're going to start asking questions about the banking tools that we're using, and hopefully that's one of the main points that you get out of this class. Why don't more people do this? Well, and that's one of the common questions I get. Hey, if this strategy is so great, then how come everyone isn't doing it? Well, I would say that the biggest reason is because banks are businesses. Their goal is to make as much money off of you, their customers, as they want. Or as they can. So they're not going to tell you about it. And if they don't tell you about it, well, school never told us about it. School told us very little about finances. So the biggest thing is people just don't know about it. And that's why I'm here talking to you about it, because I think it's an amazing tool. I think more people should be using it. Another reason is financial advisors have never heard of it. Banks don't want you to know about it. The mainstream media doesn't understand it. Your parents didn't do it. Dave Ramsey and Susan Orman didn't teach it. And your broke brother-in-law said not to. Those are probably, the top 7 reasons why people don't actually go out and use this strategy. And it's sad because they would save so much money and pay off debt so much faster if they actually understood it and used it. So one thing to remember as we're going through this course is that cash flow is king. Remember, we talk about that a lot. Cash flow is king. This is a cash flow based strategy. People come back to me all the time after they watch the velocity banking or the speed banking class, and they say, well, I've got this line of credit that has an interest rate that's way higher than this amortized loan. Shouldn't I just be staying in the amortized loan? No, interest rates do not pay off debt. Cash flow does. So we make decisions based on cash flow, not based on interest rates. The wealthy focus on cash flow more than anything else. Robert Kiyosaki said, I am a cash flow guy. If it doesn't make me money today, forget about it. The traditional way to manage your debt and finances is designed to lower your cash flow. Now, we're going to talk about this more in Module 6, so stay tuned. Speed banking is powered by cash flow, not interest rates. We talked about that. Most people are distracted by advertised rates, and they don't understand how they're going to apply to their personal scenario. The way that banks advertise the interest rates on their products is very misleading, because it makes you think that one product that you're getting into is better when actually it's going to stretch out the amount of time that you have to pay it off and thereby cause you to pay more interest, rather than something that may have a higher advertised rate but is a little more flexible and you could pay it off even faster and pay less overall interest. So we're going to debunk the myths of interest rates in this class. We were all taught not to ask questions when it comes to finances. That's part of the folly of being taught what we're taught in public education. We are not taught a whole lot about finances, and so we tend to just kind of be scared of it, and we just do what our parents told us to do, or what they did, or take advice from people that aren't necessarily in a great financial situation. Ask yourself, do I want to only achieve what my parents achieved financially, or do I want to achieve more? Because if you only want to achieve what your parents achieved financially, then fantastic. Take their financial advice. You'll end up just like them. Otherwise, you should be studying finances. You should be studying banking and taxes and all these things so that you understand, real estate investing, business ownership, so that you understand how to go beyond what they did. And it comes back to analogy. Would you trust a skinny chef? Well, don't follow broke examples then, right? You'd never go out and get fitness advice from a fat coach. So, don't take advice from broke people when it comes to finances. Our key goals in this class, as we go through the class, our key goals are going to be to help pay down debt, to create control and more cash flow, more financial security, responsible credit utilization. This strategy does use your credit. So, but we're going to talk about how to do that responsibly and why that's okay. One of our goals is to pay less interest. And then, of course, just like, I talk about real estate investing all the time, absolutely one of the goals is going to be to invest in more real estate. Now, as we go through this class, we're going to talk about some assumptions. And most of the time when I'm talking about examples, these are the assumptions that I'm making. That figures and numbers have been rounded to the nearest dollar or whole dollar for simplicity during the class. And as we teach, we're going to be using some assumptions that your income is going to stay the same and stay stable and not increase or decrease, that your lifestyle will stay the same. Now, you're going to hear me use that word a lot, lifestyle. What I'm talking about when it comes to lifestyle is non-debt related monthly expenses. So things like the cell phone plan that you chose. It's not going to be something or speed banking is not something where you have to decrease your lifestyle necessarily. So we're going to assume that your lifestyle is going to stay the same. That your cell phone plan stays the same, that you're going to keep your Netflix subscription, that you're going to eat out just as much as you currently do. So we're going to make that assumption. And there's also an exception to every rule. So we're going to talk about those exceptions as we approach them. But I just wanted to be clear on what our assumptions were going to be today. Now, as I talk about this, and new students especially will come to me and say, well, I've been taught that debt is bad my entire life. And the thing about debt is it's not bad. It's actually, I like to use the analogy that it's like fire. Fire is not bad and it's not good. It's a tool. Fire is something that can burn your house down, or it can power your car and warm your house and cook your food. It's a tool. You can use it for bad or you can use it for good. And, debt is the exact same way. You can use it for bad or you can use it for good. So we're going to show you ways that you can use debt and leverage debt in order to pay off your debt faster and get to a point where you're financially free. So as we go through this, I'm excited to dive into the content here and really start to dig in and teach you the principles of speed banking. So that wraps up Module 1, our introduction module. In Module 2, we're going to be talking about debt payoff. So we're going to go through the entire speed banking strategy. We're going to apply it to the average American household financial model, and so that you can see what happens to it. And hopefully you get a good overview. And then the rest of the modules after that, we're going to be breaking it down and kind of getting into the nitty gritty of it and how you can start applying that in your own life. So I will see you in the next module, in Module 2, Debt Payoff. We'll see you there.